Thank you. I can see people joining. We will start the session shortly. Good morning, good afternoon, good evening, tax fans, depending on where you are located. And welcome to the 5th session of our Global Indirect Taxes event series. Today, we will host an interactive virtual session, and we're not alone. I'm happy to share with you that many people from all over the world have registered for today's event. This series of events will help you and your organization navigate the significant changes that have been made to indirect taxes globally and provide an overview of technical and commercial considerations across all key jurisdictions. Today's virtual event will cover an update on customs requirements, both within Europe and globally, and the impact of recent events on existing supply chains and additional costs. This is the 5th of a 5-part series, so the final one, dedicated to indirect taxes. Please take a few minutes to read through the disclaimer for this event. We truly look forward to all of your questions and comments. You can do so by using the Q&A box on your toolbar at the bottom of your screen. Even if you cannot see the questions, the host can see them. Due to time restrictions, our presenters will do their utmost best to respond to all questions received during the event. We will also conduct a short survey at the end of the event, which will be anonymous, by the way. We would appreciate your honest feedback, as this enables us to improve our virtual event offering to you. The survey will automatically pop up on your screen after the session ended and will take less than 2 minutes to complete. By way of introduction, my name is Stefan de Keulaar. I'm PKF International's head of tax. I'm based in Belgium, and I'm joined throughout the series by Luigi Lungarella, who leads PKF International's indirect tax pillar and who is a member of the International Tax Committee. Without any further ado, I will give the stage to our first presenter, Luigi Lungarella.
Grazie. Grazie, Stefan. Thank you very much for having me here, and especially thank you for hosting this series of events run by the members of the PKF International Indirect Taxes Group. And I'm delighted and rather proud to be leading the group, and can rely on a rather cohesive team of passionate and talented individuals located around 480 offices in over 150 countries. And this series of events has seen a number of members of our indirect taxes team from all over the world, providing you with some useful tips that you can adopt within your own organization. And as PKF International Indirect Taxes Group, we have monthly meetings aimed at minimizing as far as possible exposures and maximizing opportunities for you, for our clients. And since the taxes that we deal with are normally based on common European legislation, which is often interpreted in different manners, we, as tax advisors and our client base, we have benefited enormously from these brainstorming sessions. And on top of our monthly online meetings, and after a couple of years of what I would call justified absence, we're also back at regularly meeting up in person. So, for example, we also met up together with the rest of the International Indirect Taxes team in Limassol in Cyprus just 2 weeks ago, in a highly successful event organized by PKF International, involving 130 colleagues from all over Europe. And the weather in Limassol was considerably better than over here in London, but we refrained from enjoying it and instead explored fascinating developments, including VAT and technology, EU developments such as the VAT in the Digital Age project, discussions on EU CJ indirect taxes cases, the significance of the developments affecting VAT and the financial services sector, and of course, indirect tax matters affecting the cross-border movement of goods, including the hidden costs and challenges of customs. And this is because businesses trading internationally, and in particular within Europe, have real problems in relation to indirect taxes. But any business trading internationally should not solely focus on VAT or GST matters, but also on considerations affecting other indirect taxes, such as insurance premium tax, such as air passengers duty, such as customs duties across the world. So a global indirect taxes approach is often required. But today we will be focusing on the latter, on customs duties and how these matters affect VAT considerations as well. And in order to do so, I will be joined by Ali Aktash, who has more than 20 years experience as a customs advisor, has previously managed in-house customs brokerage teams and successfully implemented special customs regimes such as bonded warehousing, inward processing relief, and authorized economic operator programs in different industries. And Liam Dushinsky, who heads up the customs duty team in Exeter, is a chartered accountant and chartered tax advisor, and is also a member of the Customs Practitioners Group. And our respective teams, together with indirect tax practitioners from all over the PKF network, contributed to VAT in the EU, which is an influential country-by-country guide covering all 27 EU member states and the UK, which was published by Tolly's LexisNexis last year. And we will have some more news coming up in relation to this publication, as a number of PKF authors are currently working on the next edition of this publication, which is due to be released within the next couple of months or so. And one of the topics covered in quite some detail within this publication is the VAT considerations whenever goods move cross-border. And at least from a UK perspective, matters involving cross-border movement of goods and all of the indirect tax matters, obstacles and costs relating to international trade are certainly a timely topic and a problematic topic as well, leading to several hidden costs and challenges for businesses exporting and importing goods from and to the UK. And experience has shown that many businesses trading internationally are struggling with the changes arising from Brexit. They're struggling with the process for bringing goods to the UK and consequent requirements for customs declarations and paying and reclaiming import VAT. Frequently, businesses are unsure whether they have paid import VAT at all, and if so, how this could be reclaimed. And getting this wrong can lead to expensive, irrecoverable VAT costs, as well as the risk for penalties and for the failure to submit customs declarations, or even just for submitting incorrect customs declarations. And then a lot of things have actually changed over the past 18 months or so. And there are certainly more and more challenges for international businesses based in Great Britain and for European businesses trading with Great Britain. So, for example, businesses in Great Britain are at times unable to take advantage of the EU VAT simplification measure known as triangulation when selling goods to the EU. Triangulation is in several circumstances, although not always, no longer an option for businesses in Great Britain, because it is usually only relevant if all the three parties are based in the EU. And the fact that it is sometimes cannot be used can of course lead to much increased compliance costs, and it might be necessary for these businesses to register for VAT in the country to which goods are sold. And then businesses based in Great Britain need to deal with additional compliance steps, such as making export declarations to get the goods out of the country and deal with import declarations once the goods arrive in the European Union member state. But that is, of course, dependent on who acts as the importer on the customs declaration, another topic that we will be going through later on within this session. And later on in this session, we'll also be going through a number of additional shortcuts that our client base can take advantage of, including direct shipment and the scenarios where customs duty does not usually arise because of the Brexit trade deal. And when it comes to the time frame related to these recent changes, we need to bear in mind that full customs control came into force on the 1st of January 2022, which may affect businesses that move goods between Great Britain and countries in the EU. And these include requirement for full customs import declaration for all goods at the time businesses bring them into Great Britain, unless of course they are non-controlled goods imported from Ireland. Customs controls at all ports and other border locations. The requirement for suppliers declaration providing the origin of goods if they're using the zero tariffs agreed in the UK's trade deal with the EU. And we should also not forget that commodity codes are changing. And with the grace period now over, UK businesses that export into the EU can no longer afford to be complacent regarding rules of origin. And under the UK-EU Trade and Cooperation Agreement, exporters now need to provide clear and sufficient evidence to prove the true origin of their goods if they want to continue to qualify for tariff-free trade, or of course risk paying duties. And we're now noticing that many products are not meeting the required threshold of 50% British or EU source content to qualify for zero tariffs under the Trade and Cooperation Agreement. And this is leading, of course, to potential penalties. But most importantly, these exporters face the daunting prospect of informing their EU customers, forcing them to amend their import declarations and to pay the necessary duty, which is of course something that does not necessarily work well from a commercial basis. And it is now more important than ever to tackle the several reasons behind the uncertainties affecting businesses trading with the EU. And these are linked to misunderstandings on how to operate the new postponed import VAT accounting scheme. Bear in mind that in the UK, only the owner of the goods is entitled to recover the import VAT paid on their importation to the EU, into the UK. We also have delayed customs duty declarations, bearing in mind that many imports that have been made utilizing this easement without importing business being fully aware of what this means and the actions that need to be taken within 175 days of the arrival of the goods. Temporary ORI numbers, which were introduced as it can take several months over here in the UK to register for VAT, but without full planning, the import VAT can become an unexpected cost, eroding or even just taken away in its entirety the supplier's profit margin. The paramount importance of Incoterms, that are a set of rules which outline the role between buyers and sellers for the delivery of goods. And last but not least, matters arising from insufficient or inadequate communication with the customs agent completing the customs entry. And since there are a number of customs agents attending this specific webinar, I would be curious in finding out whether there is anything that they would like to share on how communication be more effective. And all of this bearing in mind that customs duties are hidden but pretty extraordinary cost. In the UK alone, businesses and consumers have paid 62% more in customs duties on goods imported to the UK over the last year as a result of Brexit customs changes, which are starting biting. And while some of the increasing customs duties, of course, must be as a result of the recovery in trade post-pandemic, it is obvious that the majority of this increase is due to Brexit. And the main increase in customs costs comes from the new rule of origin tariff, which applies to the import of goods from the EU, which were originally made or contain components made outside of the EU. And it is fair to say that these outstanding increases could be mitigated through careful planning, through considerations relating to supply chain structuring, and simply put, by engaging our customs specialists. So it is probably a good time to take a little step back and to consider what are the key areas that businesses and advisors need to consider when considering customs matters worldwide. So over to you, Ali.
Thanks, Luigi. Thank you for everybody for joining this seminar. Like Luigi has mentioned, during the seminar, we want to give you some insights on certain custom topics. The main topics what we would like to discuss during this seminar is classification, how the goods should be classified, the downsides if you do the wrong classification, how that can impact your business, the origin of goods, like we mentioned. Is it preferential origin, non-preferential origin? How could that impact your custom duties when you're importing goods? The valuation is also, sorry, valuation is also a very important topic. If you look to the key areas within customs, we need to make sure that the goods are valued correctly, and that's something we're gonna also discuss during this seminar. We're also going to touch bases on the Incoterms. As we have mentioned, Incoterms can impact the customs duty and how that can impact the customs duty, and what should we look into when we decide to use which Incoterms we're going to use. We're also going to touch bases on the release short, because we're going to only just mention a few of them. The reason for that is actually, if you want to optimize certain duty impacts, there are some reliefs what you can make use of, and that could be also what could be also implemented. And we're going to give some examples, and those examples will be some of which have currently took place in Court of Justice, and some of them are practical examples what we have seen ourselves with our customers. So for the key areas, we're also going to give you a short overview, and Liam is going to give you some insight on the short overview.
Okay, thank you, Ali, and greetings all. Yeah, I always like to start with how customs work diagrammatically. So if you put a line through the middle of this page here, you have above the line and below the line. So every business or advisor, generally, as a starting point, you need to figure out how much duty is payable, and if you actually care, and if there's anything you need to do about it. So in order to figure out how much duty is payable, the first thing, which is probably the most key aspect of customs duty, is to classification, because everything is driven from classification. But once you know how to classify your goods, and we'll talk about classification in a bit more detail in a moment, you'll get your code. Your code then dictates which rate you apply. Once you've got your rate, you then figure out how much your item costs. There are lots of quirky rules around valuation, and it's a common mistake we see from a lot of businesses, and they end up getting quite a big bill unexpectedly. So we will talk about that as well. But one will give you a rate or a percentage, and you times that by the value. And generally, this determines how much duty you have to pay or how much you're looking to save, which then brings you below the line. And There are things in place that administrations or customs authorities, etc., or governments will put in place to enable trade to continue in that local jurisdiction. And they also want to facilitate trade between member states or other countries around the world. And that's where your origin stroke preference comes in, because actually, if you get your goods from a certain place or you're sending them to a certain place, there are actually ways you can mitigate, reduce, sometimes to nil, how much duty is payable. And failing that, if you're going to be bringing goods in to work on and then maybe sent back out, or just holding them temporarily, or doing certain other things, sending out to come back in, there are special procedures which mitigate the impact of customs duty, which is an increasing cost every time you move goods across borders without an end sell in some instances. But if I consider these in a bit more detail on the next slide. So commodity code, I've said before, it's very key. For me, it's king. And the reason being, the code will not only determine what duty rate you pay, but also is used for things like what test you use for origin tests. It will also determine whether there's restrictions on whether those particular goods can come from that country and be entered into here. So whether you need licenses or other documentation. Certain goods will require to be signed off by your local embassy before they're transported. So there's loads of things which are derived from the commodity code. So if you get that wrong, then basically everything else, it goes out the window because it's all wrong. And there are penalties for getting things wrong. For the rules of origin, it gets pretty complicated. I mean, for commodity codes, there's 16,500 different commodity codes around Europe for rules of origin. Generally, if you're looking at free trade agreements, the EU alone has over 42 free trade agreements, and they've all got different rules. So there's a lot to get your head around. There's the basic concepts of how preferential or non-preferential origin works. Everyone always thinks it's the same as being shipped from, and it's not. And you can get into hot water pretty quickly. We will go through those in the next couple of slides, but it is very key to understand that origin is not simple. There's a lot more to it, and businesses and advisors need to be aware that actually there's a lot to do in order to be able to benefit from some of these reliefs. The customs value, generally, when we talk about values, it's what the percentage is applied against. So CIF is what we use in the UK and the EU. So the cost of cost insurance and freight is the value we use, and you might have to add or deduct things, and we'll talk about that in a lot more detail. And then the reliefs, the most common reliefs, and they are pretty much around the world, are inward, outward processing reliefs. This is when you're bringing goods in for repair or to be worked on, or sending goods out to be fixed or to be worked on. And if you're not going to be doing much to the goods, then customs warehousing, which is also referred as bonded warehousing, etc. These are reliefs that allow both the duty and the VAT to be suspended, which can be very beneficial, especially if you're not the owner of the goods, which Luigi touched on, but we'll talk in a bit more detail a bit later. But without further ado, before we move on to classification, I think it's probably worthwhile just asking the first polling question. So how does your business deal with classification? And this is the question that most customs authorities will ask if they're ever visiting. So in the UK, HMRC, it will sort of ask this question as an opener. So do you use the codes that the suppliers give you? Do you have trained staff and documented procedures? Do you outsource it to someone that knows what they're doing? Do you Google it? Or do you do what the agents tell you to do? Which they shouldn't generally tell you, because you should be telling them what to do, but quite often they will give you a hint of what codes they think you should use. So be interested in getting your thoughts. If we give it a few more seconds, and then let's have a look at the results, if we may, please. I can't see any results. Oh, there we go. There we go. Yeah, actually, I'm not surprised by that. And I'd say a third of you using what the suppliers give you. That is generally what most people do. And Ali will tell you why that's a bad idea in the next slide. So if I pass you on to Ali.
Yeah, thanks, Liam. Like Liam mentioned, you know, what we see in the practice is that HS codes mainly is used what the supplier is providing. That could give you a good indication, but only on an indication level. So you could use the first 6 digits of a classification code, which are international and is actually based against the harmonized system. But after that, actually, you will lose the real classification of a product, because Chinese classification or the European classification, they differ from the 6 digits on towards the 10 digit, and also the additional digits what you need for importation based on the nomenclature is for measure requirements. So if a product needs to have certain measures, you need to make sure that you have the right classification. Having that said, we're just trying to give you here some high indication of how the classification codes are actually used and what the system to do the classification code. What we haven't mentioned in here, but there's of course the rules on classification, how you should classify the products. There's also of course more additional information regarding it for each heading on classification. It is a separate topic, classification, and we'll also see on the next slides what a difference would make if you have a wrong classification, outside of course of the penalties you would get, but also the import duties you could incur even if the last small digit changes or not within the classification code. So on the classification code, I think if you would have some challenges or if you have some doubts, we would not recommend just to go on the information which are provided by your supplier or referred by your custom broker. To be on the safe side, you can at least apply for binding tariff information for your classification codes, or just have support from specialists on this topic. So for the classification, we will just give a practical example.
Yeah, well, I think it's probably useful to, both Ali and I could probably spend all day talking about classification easily. It's a massive topic, but because this session's about pitfalls and challenges and what you should be aware of and hidden costs, we thought we'd share probably the most common mistakes we see. And I break it down into 3 things. Before you start classifying, you really should have people that know what they're doing. They should be aware, A, of how the rules work, and that, Ali mentioned BTIs. BTIs are binding tariff informations, which are rulings within the EU. We get ATRs, which are advanced tariff rulings in the UK. I know the US has something similar. I know China has something similar. So there are lots of sources of information, depending on where you are in the world, where you can actually try and find someone that's probably classified something similar to what you're looking at and got an official answer, which is usually legally binding on the person who asked the question, but is usually very persuasive if you're arguing against your local customs authority. Quite often, to do classification, you need to be pretty clued up on what the item you're classifying it is, the technical details, what it's used for, what it's made out of, any measurements such as voltages, tensile strengths. It gets pretty complicated, and I know that both Ali and I have done things on the pharmaceutical businesses, and you need a chemistry degree to be able to understand some of the things it's even talking about. Then when you're doing the classification, you need to understand how the rules work. We refer to these general rules of interpretation. They are essentially issued by the World Customs Organization. So 145-ish countries should be using the same rules. There are lots of rules, 6, which try and help you figure out how to navigate the massive book of codes, which I said, 16,500. There's also legally binding sort of chapter notes, etc., depending on which tariff you're looking at, from whether it's the EU one or whether it's your local tariff. There'll be something where you can follow. They've tried to give explanatory notes. People don't generally know where these are or how to find them, but you'll find that the local authority will generally refer to these when they're trying to penalize you or trying to say that you're doing things wrong. And another thing which we see quite often is when we ask clients and they said, yeah, we did do it. We say, well, have you kept a record of what you've done and why you did it? And also, there has been a recent change. The harmonized system codes, which basically is the underlying thing for all codes, is updated every 5 years, and 2022 is the last time it was updated. So there have been a lot of changes recently. So the codes which you may have in your system that are already in place, they actually may need to be reviewed and rectified because there have been some changes very recently. And the best way to sort of, I suppose, give you a bit of a practical example of some of the things we've seen is a real life example that I've done here in the UK with the local customs authority, HMRC, and it's to do with a ceramic chicken. So if we go to the next polling question, let's see what you think. So this is pre-Brexit, so because they can go back several years and assess. The client brought it in at 6.5% duty. And what did HMRC think? Did they agree with the original classification, which ironically was the classification which the overseas supplier had used as an ornamental item? Did they believe it's actually an item of kitchen stroke tableware, which is 9%? Or did they believe it was the same, again, but with anti-dumping duty? This is something which we'll talk about briefly in a moment. But essentially, you've upped it from 9% to 45%, or did they think it was meat of the Gallus domesticus family, which is Latin for red jungle fowl, I believe, which is actual real life chickens, or did they believe it's 0% as a toy? So let's see what you think. Okay, and let's have a look. Yeah, I thought more people would think that HMRC were very mean. Actually, HMRC started to believe it was 45%. We managed to convince them it was actually an ornamental item because there's lots of guidance within the Harmonized System Explanatory Notes. We could find things in BTIs. We managed to convince them otherwise, but it was a six-figure sum that they were being assessed for. And if we didn't get this right, as most businesses will probably vouch, having a six-figure assessment will probably damage a lot of profit and loss accounts going around. So it is something to be aware of. If you don't have the tools in your arsenal to be able to justify or back up or quantify, how you reached that decision, you're sort of leaving yourself up for a fool. Which I suppose then leads me to my next question. We're going to talk about origin. So let's just have a quick understanding of what you guys think. So, how does your business deal with origin? What is origin? Do you even know what it is? We use origin statements when your customers ask you to, or you have documented procedures regarding tests and evidence, and you know them for every single agreement out there. We've heard of it, but don't really know how it works or what to do. So let's see how honest you are. So yeah, let's have a look. Okay, so everybody's heard of origin. I'm glad, but that means the next session is going to go slightly easier. But yeah, okay, great. Well, in that case, I'll lead you to Ali. Let's go.
Yeah, so it's good to see that origin is not that difficult as we think it is, but I would say maybe it's difficult than what we think, and the reason for that is when we see what's happening in the practice and also the court cases regarding the origin, and that is not that straightforward. So the origin is not actually where the products are produced or wholly obtained. That's something what we all think, but that production or produced is actually is a tweaking part within the origin. When you produce the origin, or when you process certain products, would it get that origin from a professional origin statement purpose or not? That's something which is always in question mark. So on the origin, like we mentioned, we have two types of origin: preferential, non-preferential origin. Non-preferential origin is giving us some information regarding the most favored nation tariffs, or if it's with restricted goods for national legislations or so. And the preferential origin is mainly for duty reliefs, to see if the product can apply for free trade or not. So the determination of preferential origin is actually the most challenging part, to see if the product fits the test or the evidence requirements on depending on the type of free trade, because not every free trade agreement is been settled the same way. Some of them are value based, some of them are different. So it's really tricky. It's really I'd say challenging to determine the origin of at least the preferential origin of the product, and that's something we would like to pointed attention to, saying, okay, guys, if you determine the preferential origin, do you have evidence on the supplier declaration, what your supplier has provided to you? Are you keeping records of that? Because we're going to give you some example on that, what happened with that in the practical sense, on the evidence and also the supplier declarations, if they have been provided or not, and also if they meet the tests. So for that, meeting the test of the preferential origin test, that something is also important in the sense of the changing environment. You know, sometimes it could be that at the moment when you do the test and you check your products for preferential origin, it meets the test, but certain things can change. We are in a changing environment, costs can change, suppliers or your routings for your supplier can change. So you should be really aware of this whole process, and you should maintain this process for a long period. So it's not something statistical data what you say, okay, we have this information available and we don't need to look into it. It is dynamic, and that's what we would like to emphasize here also when we discuss about origin and preferential origin. So we will give you some more insights on preferential and non-preferential origin.
Okay, so yeah, I mean, we thought it'd be useful to share what actually the legal description of what preferential and non-preferential is. And generally, if something is homegrown, comes from the ground, etc., it's wholly obtained. But if it's not, and you get a combination of things and then work on it, then generally it needs to undergo a certain amount of processing. And they look very similar at this level. So whether it's wholly obtained or undergo a certain amount of processing or undergone its last substantially economically justified bit of work, what you notice is the preferential bit is generally, because there's a tax saving attached to it, it's much harder to hit the preferential test. And when it says undergo a certain amount of work in a processing, each free trade agreement, they're generally very long and they cover lots of things, not just goods, but within in the free trade, I mean, take for example the TCA, which is the EU UK one. There's I think it's around 1,400 pages, but about 500 pages of those is all to do with origins and the tests. And within the test, you could have a value test, like Luigi alluded to earlier, where you have to have 50% of the value comes from either the UK or EU or a country you're accumulating your items with. Or it can also be a change of classification. So the final product is a different classification to everything that went into that final product. Or for certain like pharmaceutical type products, it must undergo a certain type of process in order to be originating in that particular country. So there are these list rules. So it is complicated because you can't just say, well, I think it comes from there. You need to understand what the commodity code is, what list rule you're looking at, and then you have to understand which country you're sending it to, because there's different list rules for the 42 different free trade agreements that the EU has. So if you're doing it as an automated system, then you have to program the system with a lot of data in order to be able to give you the right output. But it can get pretty complicated pretty quickly if you've got lots of items and lots of sort of purchases as well as sales. But if we move on to the next slide, we just see diagrammatically from one landmass why it's important to understand the difference between them. If you're trying to import stuff into the EU from North Korea, well, the non-preferential test basically says if it comes from North Korea, there's loads of sanctions here. The goods will not cross the border in the UK. It will come onto the it'll hit the customs border, they check the origin. If the origin is North Korea, it's generally banned and you're not allowed to send goods there or usually import goods from there. But if you're going to South Korea, actually the EU and the UK both have a free trade agreement with South Korea. You need to understand what the rules and tests are. And if you meet them, you can do certain things on your paperwork, which will allow duty-free trade between them. I mean, it's probably useful to, I mean, Ali, if you take them through the next example of a practical, costly example.
Yeah, so here we have two examples. One of them is actually an origin example, so non-professional origin. The goods which are imported in UK for a UK business, actually they were thinking they were importing goods from India, and the specific goods what they were importing is solar models from India. So that was the whole information what they had at hand at the moment. But fortunately, it seems that the goods were actually not from Indian origin because of the processing that happened in India. It was actually cells which were produced in China who were assembled in India and then shipped from India to the UK. And in this case, it didn't give necessarily Indian origin to those products. So in this court case, it appeared, fortunately for the customer, that they were actually classified as Chinese goods, so not on top of the duties which were actually for China into UK. There were also additional anti-dumping duties that they had to pay on top of this, on top of the duty. So what we're trying to give here, or to point out, is even if you have some documentation showing that the goods are shipped from India and the goods have been processed in India or in some other country, you need to have, as an importer, dig a bit more to understand if the products are really of that origin where you're importing from. So this court case gives it really a good sample of saying, okay, you as an importer have more responsibility just for taking granted the information which has been provided to you. So that's one thing what we need to consider when we are importing goods and when we are looking to the origin of goods. The other example we had here is, like I mentioned before, it's actually an approved exporter license. That's more for the export side. So a Dutch customer of us who had actually this license since 2013, they had it and they were using it. So what does it mean? So that means that you actually give your customers an authorization saying that the goods are from Dutch origin and they can claim reliefs, import reliefs, based on the free trade agreements which are between for this case Netherlands, Mexico, Netherlands, South Korea, etc. So Europe and the other countries where the free trade agreements are based on. So they had this license since 2013. The Dutch customs had issued an inquiry and asked them, actually, can you prove what happened during those years, that you have the proofs of that the goods are meeting the tests and the requirements for preferential origin. And that was actually something what they really need to look into and make sure that all the paperwork and everything was in place, because they didn't meet the tests or they didn't check on a yearly basis if the products were according to the requirements and they were of preferential origin. Eventually, this inquiry resulted in a positive way, because most of the products and most suppliers of this specific customer were not changed. They were still from suppliers from Europe, but it could be the case that some of the suppliers could change. They could be sourced from outside of Europe, and then at that point, the goods could not meet the tests, the value tests, etc., and that they were actually issuing incorrect preferential origin statements on their invoices. So that's something what we're trying to point out here is saying, okay, having a license in place doesn't mean that you just can go on with it. You just really need to be on top of it, and also make sure that your supplier declarations are yearly renewed, that you check if the cost changes. If you look what currently happened in the last 2 years, increasing cost of raw materials, how that impacts your goods, if it impacts it or not, and that you still meet the requirements. So those were the two examples what we would like to give you as a heads up on this.
Okay, and I suppose that brings me again onto common mistakes that we see a lot of our clients, businesses generally just not understand quite how it all works and how it can impact them. But yeah, I mean, we've alluded to generally, I mean, I think it was 0% of people who didn't know what origin was. So at least you know what origin is. Hopefully, you know it's now not the same as shipped from. But quite a lot of people didn't realize, I mean, 50% test that Luigi mentioned earlier, that could be 30% from one country. You could even be low as 10% from, depending on which free trade agreement you're looking at. So you need to be aware that it's not just a set percentage. It can be a variable percentage depending on which country you're dealing with, and you need to know how to find what the rates are within the agreements or the European database. There are lots of different places you can go to find information, but it's not always easily accessible. Quite often, the good news, sometimes you go to businesses and you say, oh, you're getting it from Mexico. Did you know you could import that free of duty? And sometimes they don't know. They don't know that there's all these countries out there where they could have claimed preference. And sometimes you can retrospectively go back if you can get the evidence and get some money back, or you just have the saving going forward. Ali's mentioned about the pandemic and the geopolitical situation is increasing costs. And if you're getting stuff from abroad, actually the costs of your non-originating items is likely to go up, which means you may no longer meet the test. So how often do you check it? Do you do it monthly, yearly, real time? You know, these are things you need to factor into what your businesses should be doing. Another big one is supplier declaration. So the whole thing is, how do you know where something has come from? And the answer is generally people don't want to tell you the ins and outs of everything of where they've got the goods. So there are prescribed forms which you can get from your suppliers, which say, well, actually, for the purposes of this free trade agreement, we can confirm that actually is of this origin status, so that you can use it in your calculations in order to go forward and be able to maybe claim preference. And they should be vetted if they give you a statement, they will be vetted to make sure that what they've said is correct. So if you don't hold a lot of this evidence, then actually it's a thing where HMRC will say, well, if you can't prove that that is the origin status of that good, you have to take it as worst case scenario. So yeah, I mean, it'd be useful probably to just have a look at the importing and exporting bit. So what to do and when on the next slide. So if you're exporting, you need to hold that evidence. So the long-term supplier declarations, etc., that I mentioned a moment ago. And if you're going to do it, you need to understand which free trade agreement you're doing it under, and whether you need to do a thing like a statement of origin, whether you need a certificate of origin for your Chamber of Commerce, whether you need to be an approved exporter. And if you are, do you put your reference number, and where do you put it on your commercial documentation? So there's lots of things you need to be aware of. It's not simple of, I deal with that country, therefore they should be able to claim preference. There are steps that need to be taken and things you need to be aware that, you know, that you have to have done before you can give that statement. And consequently, when you're importing, have you told your agent? Because you should give them the instructions that they're claiming preference. And, you know, if you are going to claim preference, does the commercial paperwork support that preference claim? So does it have the statement of origin? Or if you're importing from a connected company, do you know what the constitution of the bill of materials, etc., is, the cost components? Can you use importers' knowledge to say that actually you know that they would have met the test anyway? So there's lots of things to think about. But that's enough about origin. I think we'll probably move on to valuation next.
Yeah, so we just discussed classification, origin, and the other main topic for calculation of your duties is, of course, the value of the goods. So how is the valuation? Is there a logic behind it? Yes, there is, of course. I mean, there's from the OECD, there is the way how the customs value should be determined has actually been internationally standardized, and it has certain methods. Sorry. So there are 6 methods for the calculation of the customs value. And these methods we just also, you can see on the slide, we mentioned also here, transaction value method, the identical goods, and the similar goods, deductive method, the competitive method, and the fallback method. They have to be on certain sequence. So you can't just choose a certain method. You need to make sure that you go through these methods one by one. And if you don't meet the requirements of this calculation methodology, then you can go to the other one. Only that can change on the competitive and the deductive method. There you can just slightly change it based on the requirements. So with the other first 3, you need to make sure that you actually continue with the methodology, and also the number what you need to make sure that you do the valuation on. Customs values, the other reason for the customs value and why it's important is actually it's not always the transaction of goods, the value of transaction of goods. That, you also have intercompany pricing, so where the intercompany related parties are actually selling goods to each other. How that value is actually been determined is also one other element what's important to know. And we also have an example of a court case regarding the valuation. Actually, there was this mainly on valuation between intercompany of a related company in transactions, but it is not that straightforward. So I mean, if you have purchases from suppliers where you are not related to on any transaction value, is the straightforward value what you can use, then it should be okay. But sometimes it's not that straightforward. There are royalties, license fees, what actually Liam's also going to go into, or other type of costs what you need to include in your customs value. That's something we will also go into on the next slide, Liam.
So it's probably useful for me to jump in and say, yeah, I mean, within the EU and the UK, basically these items are contained within the law, and they're common throughout the world. I'd say the biggest mistakes I see for businesses when they're doing their calculations of what the value is, they quite often exclude things like royalties and license fees, mainly because they're invoiced separately. So they bring a good in, but they then realize they have to pay a Disney royalty or a Marvel royalty or something extra. And depending on how the royalties are set up, it usually has to be added to the price, at which point it increases the cost to bring your goods in and increases the amount of duty potentially payable. Another one is tooling. So quite often you might outsource your manufacturing operations to somewhere like China, but you will create a tool or a die or something which they can use to make the items out there, or you may even pay for it to be made out there. But that's not reflected in the cost of the components coming back in. But you need to do something about that. You need to do a value adjustment to change that. And these are also questions which the local customs administration will ask. It's not all losing, because sometimes you can deduct things off the price. If there's a buying commission, you can remove this. Sometimes management fees, etc., are included in it. You can sometimes remove those as well. And the delivery costs inside the territory. So it used to be quite an interesting one where if you flew goods in from China into the UK, you didn't have to account for the full freight value. You could potentially reduce it by 30%, because actually it crossed the EU border at a certain point when it flew over the first European country. That's technically when it entered the territory. So actually it can get quite complicated, and there are things which can potentially save you a little bit of money. But it's useful probably now to move on to the European case, which Ali was referring to a moment ago.
Yeah, so we took example of the Hamamatsu case. I don't know if it's familiar to the audience or not, but it's actually a case regarding transactions between two related parties. In this case, a Japanese company, Hamamatsu Photosonic Germany, importing from the mother company from Japan. There was actually an APA, so an advanced price agreement in place with the German tax authorities for this intercompany transactions. And on this case, there was a retroactive transfer price adjustments issued by the German entity, and they would like to claim that import VAT back from the German authorities, and that has been refused. So that is actually the basis for this court case. So the refusal of that request, and the reason for that refusal was actually that the way how this actually how the request has been issued, that's how we look at it. And it's not because that transfer pricing agreements cannot be used as basis for determining the custom value, but it's just the way how this how the request was issued to the Dutch authorities, and the way of how this has been totally calculated. So it's more a technical way of the request, which has been refused by the authorities itself, than the transaction between related parties, which cannot be used. The transaction value cannot be used between related parties based on transfer pricing agreements. So this will still have, I think, some output because we still not clear, because the local customs authorities are still not clear on this decision, how they should treat this decision itself. In the sense of, can we actually determine transaction value for related parties or not, and can we do retroactive reclaims on transfer price adjustments, and how we should handle these ones. So we will, I think, probably come back to this later on when we have some more insights on this case itself, because there is a decision there, but it's not clear, and there are more to come on this specific topic. But we just want to mention that it can be complicated to determine the valuation of goods, and definitely between related parties when you issue the customs value. So having that said, I think we will go to give you some insights on the Incoterms and the challenges on the Incoterms.
Yeah, I mean, for me, this is probably one of the biggest areas we've seen since Brexit. A lot of businesses trading around Europe or UK to Europe, generally Incoterms were never used. So Incoterms are internationally recognized commercial terms of trade, Incoterms. And the beauty of Incoterms is a bit like commodity codes, is they break down all language barriers. So commodity codes are numbers, everybody can read numbers. If you use these particular terms in your terms of trade, everybody understands what that means each party is doing. There's no conflict or no issue to do with the language barriers. It is, if you're doing this, this is what we will say we will do. This is where we will pay for this. We will have the risk for that, etc. up to these points in time. And if you have a big argument, I think there's the European Court in Paris, which will deal with a lot of Incoterm type arguments. But if we go on to the next slide, I'll show you the actual Incoterms that are available. They're issued every 10 years. So 2020 was the last set. We thought they were going to play about with them, but generally they're pretty much the same as they were for the previous 10 years. There are 11. They're broken down into 4 groups, either when you're leaving, when you arrived, and who basically pays for which part to get to the other end. Generally, Ex-Works and DDP are what businesses like to use, because they say, I don't want any responsibility when it's left my doorstep, or I don't want any responsibility until it gets to my doorstep. They don't want to sort out the bits in between. And these are 2 opposite ends of the spectrum. And if I move on to the next slide, and Ali will talk you through that spectrum and where the things change.
Yes, I think this specific table is seen before. If you're trading, if you're within logistics or customs environment, you probably have seen this before. It gives a good indication on the terms, and also where the transfer of risk and also the transfer of cost actually goes from the buyer to seller. And also the charges and the fees which are actually incurred by the seller or incurred by the buyer are really good shown on this table. So we like to use this one to give some insight of saying, okay, if you buy Ex-Works or if you buy DDP, what could be the impact for you? Not from customs perspective also, but also from an import VAT perspective. What does it mean? So suppose if you're going to purchase DDP, what Liam is going to give you some more details on later on. But this on this table, we see that the cost transfer from seller to buyer, and also when we look into the CIF, what we just mentioned earlier, that it's the base for the custom valuation. We see that what type of cost should be included in that cost price, which Liam also mentioned earlier, and which part of the cost is actually on the part of the seller. So further on this slide, I think what we can say is
probably leads us quite nicely onto the next one, where we talk about customs representation. And what I said earlier is we generally don't like Ex-Works or DDP, and the main reason being who's going to be the importer of record. And there is confusion with Incoterms about ownership. Incoterms do not dictate where the ownership transfers, it's just where the risk and costs, etc. transfer. And the biggest issue we see with Ex-Works is if a UK business is, for argument's sake, sells to Europe and they don't want anything to do with it, the issues we have is in the EU and the UK, there's a bit of law that says the only person allowed to do a customs declaration in your country or your jurisdiction or customs or territory is someone who's established there. So the issue we have with, say, a German customer coming to pick up the goods from the UK is they're not established in the UK. They find it hard to get an agent to do their customs declaration as an export. If the item requires an export license, you need to be established in the UK in order to apply for an export license. So again, you find difficulties coming up for there. And from a UK VAT point of view, if you're going to be exporting, you need evidence the goods have actually left the UK to not have to charge VAT on that sale. And if someone else is picking it up and paying for everything and moving everything, you won't have that evidence unless you get that from them. So that's some of the issues we're seeing from that perspective. From the DDP perspective, so delivery duty paid, we've had lots of UK businesses say, I will sell DDP to Germany. What happens in reality is we tell the freight forwarder, this is what we're doing, and the freight forwarder will change it. And why did they change it? Because theoretically, we're not allowed to do an import declaration into the EU without being established. So what that means in real sort of terms, practical terms, is the agent becomes jointly and severally responsible or liable for any import taxes. So what they end up doing is just changing the importer of record to be the German customer. The issues we have with that is that we no longer have the import VAT evidence in our name. It's in the German customer's name, but we've paid it because we paid it to the agent. So who's going to be the importer of record? So there are lots of issues with DDP and X works, which is why we generally don't recommend them. But that's probably, I would say, 70% of all the issues that I've seen via Brexit is caused by the incorrect use of Incoterms, or sometimes the correct use of Incoterms, but the incorrect application by the agents who you've instructed to use those Incoterms. And there's quite a few issues that we're sorting out for lots of businesses out there at the moment who are suffering substantial amounts of 20% VAT that they can't currently recover in the different countries. And that's one of the beauties of the PKF network, that actually we've got different advisors in those countries that can deal with and try and help get that money back. But that leads me on to the next question, polling question, which hopefully it'll pop up anytime now. So are you aware of how you could be making import tax savings? So no, you just have thought they were a cost and you had to grin and bear it. Yes, but the cost of operating such a procedure outweighs the benefits. I do not understand supply chains well enough to realize whether you would or wouldn't benefit. And yes, we're doing it, and you're saving money, which would be great. You wouldn't need us. Let's have a look. Let's see what the answers are. So yeah, okay. Well, that's very honest of you all. Yeah, basically, there are things you can do about it, and hopefully we'll go on to the reliefs that well, they are pretty much worldwide, but I'll talk about a little bit more detail now. So inward processing. So generally what we find, that the issue we've got in the EU and the UK specifically at the moment, is to be able to reclaim any import VAT, you have to be the owner of the goods. So one of the issues we're seeing at the moment is we will sell the goods to a European country, they will break, hopefully not all our goods are bad, but then when they get sent back, we're no longer the owner of the goods, but we've imported them. So we get charged 20% of the VAT on the import, but we can't reclaim it because we're not the importer of record. Oh, sorry, we're not the owner of the goods, even though we're the importer of record. However, there's also customs duty as well, because it's come back. So we've got a double whammy of charges, and actually makes the whole item, sometimes you say it's cheaper to send a new one. So what can you do? There is something called inward processing, and that basically allows the duty and the VAT to be suspended while you work on those goods, fix them, etc., and then send them back out, so you don't suffer that import tax. The same sort of in reverse. So if I send goods out to be processed somewhere else and they come back in, I don't want to pay the duty on the thing I sent out because it already started here. So why should I pay duty on something that originated here in the first place? Outward processing allows you to reduce the value of the thing that comes back by offsetting it with the cost of the value of the item that went out. If you're not really doing much in the way of processing and you're just holding stock, then customs warehousing is good, because actually it suspends both duty and VAT. It's only payable in the UK if you release it into free circulation. So you pay the duty and VAT, and then you'll be able to sell it down the road. But if you're sending it back out to Europe or another country around the world, then actually you avoid all import VAT and duties, because it effectively is treated as never being here. But as with everything, to save money, you generally have to spend money to save money. And it is a balancing exercise where you have to say, well, how much am I going to save? How much duty and VAT are at stake from the operations I'm carrying out and my supply chains? And how much would it cost me to put these procedures in place? And sometimes you may have to, if it's a hard system, you might have to do a duty management system, which takes time of A, understanding how it works, and B, the cost of implementing it. But if we move on to an example, and this is an example I've seen several times, the UK used to be a hub for the EU before Brexit. So you'd bring stuff in from the US, go to the UK, and then be distributed out through Europe. The issue we got at the moment is if it comes into the UK, fine, we pay duty, let's say 6%, so 100,000, £6,000 duty. But if half of it went to the EU, because that's where half the end customers are going to be, we end up paying duty again. So it's double duty. So we pay 9K duty. But if you use, depending on if we're working on the goods or whether we're just holding the goods, IP or warehousing, potentially that actually avoids that initial duty charge. So you potentially save £3,000 in this very simplistic example. You can split the consignment from the US, but you might be paying double logistics costs. Actually, the economies of scale, bringing everything into one place first, that's attractive. But the extra duty cost, you could just say, well, why don't you send half of it straight to the EU? Well, who's going to be the importer of record? How are you going to do that? Are you registered with VAT? How are you going to reclaim the VAT back? If you are charged VAT in the EU, how can you get it back? You're not established there. Can you reclaim it? There's a load of other complications that arise from changing supply chains. And it's just a typical example of, actually, put simplistically, you could save a load of money if you did operate one of these procedures. But I think that's probably enough from us for the time being, and I'll pass you back over to Luigi.
Oh, grazie, Liam, and thank you, Ali, for your insights on the customs duty considerations that businesses involved in moving goods internationally ought to consider. And it is clear that it is now more important than ever to think about cross-border transactions, to consider supply chain structuring, and to implement robust VAT and customs duty compliance frameworks. And to do so because mistakes can be very costly and do not only have an effect on VAT and GST compliance, but also on customs duties that, just like VAT, can be subject to draconian penalties. And getting things wrong can have a real impact on your reputation, on the reputation of businesses trading internationally, and can also affect the wider commercial considerations, in particular when you employ inventory and management strategies such as JIT that align orders from suppliers directly with production schedules. And Brexit has had a real impact on VAT and customs duties, leading to changes to bottom line costs, introducing additional compliance issues, requiring changes to your systems. And being aware of these changes is paramount to manage risks and opportunities for you as businesses trading internationally, in particular when it is rather obvious that many businesses have little knowledge in customs rules and regulations, which is of course understandable, given that this is such a complex and specialized area. And the risks can be minimized as far as possible, and the opportunities exploited as far as possible, when ensuring that business models are reviewed early to ensure that our team of indirect tax practitioners can put in place a strong argumentation relying on principles of law, which, as discussed over the past 69 minutes or so, is constantly evolving. And it is therefore essential, whenever you wish to enter a foreign market, and in particular a market within Europe, that you carry out an indirect tax analysis early and consider compliance requirements. As a network, PKF, we are in a particularly good position, as we have a strong indirect tax presence in all member states. We tend to work very closely with practitioners dealing with all indirect taxes, meaning that an initial assessment should never be more than a short telephone conversation away. And I hope that you found this session helpful. And I guess that with just a few minutes to go, it is now probably a good time to leave the mic to Stefan who I understand has been gathering a pretty large amount of questions. Over to you, Stefan.
Indeed, customs duty seems to be a very popular topic because we received a lot of questions. I've noted a few down here. The first one is, we are an international business. I am based in the UK and I have had issues establishing the identity of the importer. Any tips? Maybe you can take that one, Luigi.
Yeah, sure. This question links in very nicely with what Liam was actually mentioning just a few slides ago. And just to recap, the tax rules require that a specific entity acts as the importer of goods. Now, since you are an international business, it is worth bearing in mind that it can be common for multinational groups to be unclear as to which of their specific legal entities is acting as the importer. And there can also be confusion as to whether it will be the supplier or the customer that acts as the importer. And looking at this from a UK perspective, because I seem to understand that the person asking the question is based in the UK, frequently there is a tension between the overseas seller not wanting to be the importer into the UK, as to do so would create VAT and customs duty obligations, versus the customer preferring the supplier to handle the import formalities so that the seller makes a simple sale of goods within the UK. But whatever the commercial decision, we should always bear in mind that we should not underestimate the importance of communication with the import agent. And whatever the decision relating to Incoterms, this needs to be clearly communicated to the customs agent who will be facilitating the import entry. And not doing so, or to do so in a manner that is not clear, can be a recipe for disaster.
A second question on Incoterms. I will also fire it your way, Luigi, because you seem to love that word. I am rather confused by what is meant by Incoterms. Can you explain?
Well, this also links very nicely with what Liam was mentioning earlier on, and Incoterms are effectively just a set of rules which outline the role between buyers and sellers for the delivery of goods under contracts for international trade. And the main aim of Incoterms is to take the respective responsibilities of the buyer and seller clear in order to minimize misunderstandings as far as possible. But it is fair to say, as also mentioned in the chat by another viewer just a few minutes ago, that it is not uncommon for there to be inconsistencies and confusions between the buyer and the seller about the terms being used, and in particular, who will act as the exporter from the origin country and importer into the destination country. And businesses dealing in international trade use Incoterms to define the contract terms, such as who handles customs procedures such as paying the duties and import VAT, where the goods will be delivered, who arranges transport, who is responsible for insuring the goods, and several other bits and pieces. And the consequences of all the points of confusion that we have just mentioned do not affect only indirect taxes. So, for example, where the seller has a liability to be registered for VAT, or who should pay import taxes, but also commercial consequences such as who is on risk for the goods should anything happen during that transportation. So it's not only about tax, although tax plays a big part of that.
Another question we received, I'm reading from the chat here. Please, can you advise how to manage the exports from England to Northern Ireland? Do we need to file SDI in TSS? Is this compulsory? Do you need to register or have any license to register in the TSS? Maybe A question for you, Liam?
Yeah, I think so. Yeah, I mean, generally the TSS is the system that's set up in Northern Ireland to be able to basically import. You can register with the TSS service. I think it was a misconception that everyone thought that the TSS would basically do all the customs declarations into Ireland. What it's there is generally as a helpline is, depending on which agent you're using, your agents can submit the declaration or the information required in order to provide the information. But generally, we're finding there's lots of error messages, etc., that are being generated, and the TSS are more of a helpline to answer those questions about what error messages are being generated. But generally, you would register with the TSS to be able to do that, and they would give you the access to the system to be able to implement that. Yeah, and let's say if there's, we could probably provide further details on that in due course.
Yeah.
So yeah, because I could go on forever, because it is there's a lot of issues with the TSS at the moment, and I'm thinking, I don't know if we want to try and hit a few of the other questions as well, or use the rest of the time for TSS.
Well, I've got another, because there's so many questions. It's a very popular topic. So in the interest of time, we will now take the final question, and it goes as follows. I act for customs agent and would like to confirm the importance of what Luigi Lungarella said during the introduction in relation to the importance of the communication with the import agent completing the customs entry. What I have found is that involving PKF has often improved the effectiveness of communication and reduced problems for businesses moving goods internationally. Well, it sounds more like a compliment than a question, but Luigi, do you have anything to add in relation to this?
Well, I will keep my contribution concise, since I realize that we might be overrunning slightly. It's such an interesting topic today. So, well, thank you very much. Thank you, Import Agent, for the kind words, and I'm of course very glad that our pragmatic and practical approach is appreciated not only by our clients but also by the customs agents that they're dealing with. And Stefan, if you don't mind me adding to this, we will be exploring some practical tips on how to improve communication with key players such as customs agents, such as tax authorities, in order to minimize as far as possible any leakage during the next series of events, which is due to start in the autumn and will run all the way until June 2023. And I know that we are coming to the end of this series, but I already can't wait for the next one to start.
Okay, now there's lots of questions in the Q&A and in the chat, but in the interest of time, we will conclude the webinar here, and the panelists will come back to you on a one-on-one basis offline, don't worry. So this concludes our Q&A session for today's webinar. Thank you for the questions sent through. Before we end today's session, we would like to draw your attention to some of the free tax resources which we have available. You can access these by visiting our PKF International website at www.pkf.com. I would like to refer in particular to our Worldwide Tax Guide. The 2022-2023 edition will be released beginning of July. On our website, you will also be able to locate the closest PKF firm within your city for assistance with any indirect tax challenges you might be facing. For your convenience, you can search by country, city, keywords, or use our world map to search by region. On behalf of today's panel, I would first like to thank all of you for joining us today globally. I would also like to thank all of the presenters for their hard work. Please note that we have scheduled more virtual global indirect taxes events in the second half of 2022 and the first half of 2023, which will be hosted by various PKF speakers who have significant experience in this field. The first one of the follow-up series will be held in November 2022. Keep an eye on PKF International's website, www.pkf.com, and social media pages like LinkedIn, Facebook, and Twitter for the registration information of these upcoming events. In the meantime, be well and stay safe, and we hope to see you in our next BKF virtual event. Thank you.